I think Indian IT companies are very competitive. When you look at the global space of outsourced software skills, you have a few you have a handful of international software businesses that offer the same products, but about a third of those names are Indian IT companies. And what they go through now in terms of this rise in protectionist feel against foreign workers through the visa quotas or higher visa costs is not new. Obviously, with the Trump administration, these issues are publicized, given that he has stood on a protectionist platform. That was one of the key promises that he made. So we will expect to see increased heat that way. But the issue is not a new one. And we need to also note that Indian IT companies employ a lot of engineers onshore in the US markets as well. So they do have different levers that they could use to make sure that their customers' needs are met. And we do need to note also that American companies and European companies that offer these IT services have a substantial chunk of their employees based in India as well. So when you go beyond the headlines, these are complex issues that you can't simplistically say just because you're an Indian IT company, you're going to be at the wrong end of the protectionist fervor in the US. And I think we have large positions in Infosys and Tata Consultancy, and these are two very strong operators in the IT market. This is just one of the issues that they will have to contend with.
Before I talk about Infosys, I want to also understand your thoughts on TCS. Like you mentioned, you have a large commitment towards TCS. Now, there is a change of guard at TCS, a new CEO. Chandra has been bumped up. Are you a bit worried about what could happen to TCS in absence of Chandra? Because frankly, Chandra was the driving factor for TCS. I mean, under his reign as CEO, TCS really went from strength to strength and became India's most valuable IT company.
Yeah, we like TCS a lot. I think Chandra's leadership has been quite exceptional. But TCS is too large for one man alone. It has been run by a team of professionals for a very long time. It's experienced these very good levels of stability at the senior level. And we wish him well, but we think that he's got a good team in place that will replace him, and we look forward to keeping up with TCS and seeing how they would unfold the rest of their business strategies. At this point in time, I don't think there'll be any huge chunks of change in the strategy, in the way they implement, how they aim to work with clients and meet their expectations on their deliveries. So no real concerns there in TCS. I think the challenges within IT affect more than TCS alone, but on company-specific, TCS-specific issues, we're not so concerned.
What about Infosys? Now, Infosys, they've missed the guidance for a couple of times in last 1 year. Time again, they've given a guidance and then they've come out in middle of the quarter and they've slashed it. Do you think even though Mr. Sikka is trying to reboot Infosys, there are challenges and he will have to do something special? Either he'll have to acquire growth or he will have to invest somewhere else, because this old IT model for Infosys also is getting rather rusty?
I think the IT space is always a challenging space. And you always need to refresh and keep trading, keep learning, and keep developing to remain competitive. And I think the CEO, Mr. Sikka, he comes in with great fanfare and great expectations. If you look at the numbers, actually, I don't think they've done too badly. I think he has stabilized the levels of revenue growth and earnings margins. And if you compare them against TCS, which has been the benchmark over the last 3 to 5 years, since he came on board, his numbers are comparable. I think Infosys is competitive. It has a strong team of engineers in place, and I think that his naysayers, well, it's attracted a lot of interesting speculation and excitement. But actually, when you look at the numbers, it's actually pretty good. So We like both the companies, and we think that for an Indian portfolio, there's space for both these stocks.
Finally, are you delighted that the business of ITC seems to be stabilizing? The cigarette volumes are no longer contracting. The cigarette volumes have stabilized, and the FMCG business also is on the verge of profitability. The reason why I ask you this question is because I know you own ITC, and that has been a painful position for you.
ITC has been, well, over the long term, it's been good. Over the short term, I can understand your comments. With any cigarette company, the tariff structures will impact volumes on an annual basis or a quarterly basis, depending on how regularly the tariffs are set. And what we've seen currently is a situation where we've had a period of quite aggressive demanding tariff hikes that needed to be managed. And what usually happens is that when the tax authorities find that the volumes have softened, it's usually because the tariff structures have been put up too aggressively, and they would then moderate it to try and find a balance. And that's what the ITC is currently experiencing. So over the course of the long term, you would expect ITC will have stretches where they struggle a bit to keep up with the tariff hikes, and periods where they can manage that in a more sensible fashion. Ultimately, the taxman and cigarette companies need to work together. They want to maximize their profits. They want to maximize their collection. And to do that, they need to cooperate. And over the long term, that's been the case. The FMCG business is showing good traction. They know what they're doing. They've got very strong distribution networks, and they are at the cusp of profitability, like you say. It's still early days in the market, but they seem to be making good progress there. So yes, we do like what we see from ITC currently.
A stock which you've owned for decades now is HDFC Limited. And a couple of years ago, you did indicate that HDFC is one of the most efficiently managed company in India. But given the fact that the competition in the housing finance space has only intensified and will intensify more because banks now want to be in that business, do you think the springtime for a business like HDFC, which was always considered as an evergreen business, are behind us?
I don't think it's considered as an evergreen business. It provides a good service. What you do get in India is you do get low levels of housing ownership. And it's a huge fragmented market with a lot of diversity. So each region is different, each state is different, the rural and the urban mix is different as well. And given such low levels of penetration, HDFC adds a lot of value. It's got a low cost structure. Granted, yes, what you say is right, the competitive landscape will change. But it's something that you just watch. I don't think it's of immediate concern to us. And we like what they offer to their customers and their clients. And when you look at the structures of their loan growth, the quality of their loan portfolio is very strong. When you look at the non-performing levels, they are very low. They are industry leaders there. So when you talk about a franchise like HDFC, yes, the market can get tougher, but it's still a market that's growing very quickly. So at this point in time, I think even when you look out years, there is still enough business to be made. And with HDFC continuing to focus on what it does well, I think it's in a good position to secure that growth. The other thing that's also interesting in HDFC as well has been the way it's managed its life business. There has been a lot of volatility in the life insurance business, but I think most observers would admit that it's been consistently the top 3 now in terms of brand recognition, in terms of the way they go about selling and promoting and educating their policyholders as well. So that's another leg within the HDFC group that's attractive.
You've recently bought into cement stocks, and when I say recently, 2-3 years ago, Indian cement stocks are expensive, whereas the big picture is still very clear that Indian construction activity will pick up. But your choice to buy an Ultratech Cement or Ambuja, what is the thinking behind it?
Well, you say we bought into cement a few years ago. Actually, we've had cement for a long, long time now. We've had Grasim in the days when there wasn't an Ultratech. So we've had cement exposure in India for more than a decade now. We have been adding to the position over the last 2-3 years in spite of the weakness or the softness in the cement market. And that's maybe where you picked up us buying into the cement market. What we like within the Indian cement market is that you do get some very good quality pan-Indian operators. So we hold Ultratech, we hold Grasim, we hold Ambuja as well, and ACC. And what we like is that these companies are very well run, and even though the markets are relatively soft, utilization levels among these companies are kept quite high. Cash flow generation levels are also very healthy, and valuations, they do tend to be quite volatile. So when they're relatively weak, we do like to add to these stocks. But the long-term and the mid-term case for these investments we think are attractive. And but if you have a short-term view, then you might be more trading orientated and take a more momentum-driven stand, something that we don't do.
You prompted me to ask my next question on Grasim. The face of Grasim is changing. It is now a holding company. It is not a pure play cement company. It has ownership of Idea. We don't know what's going to happen with Idea and Vodafone. But as a shareholder of Grasim, are you slightly confused with what the Birla Group is trying to achieve, or you're reasonably confident that they would protect the interest of a minority shareholder in this case?
Actually, Grasim has been a holding company for many, many years. What is the pure play cement company within the Aditya Birla Group is Ultratech. The Grasim management has always said it's always been a mix, a basket of different businesses. Cement was large because they had Ultratech, but they also had viscose fiber, they also had sponge iron, they had a few other smaller businesses as well. Aditya Birla Nouveau, which is the entity that will be that they will combine with, is also the other conglomerate within the Birla Group's companies. So what we had was an opportunity to see whether these different businesses were attractive to us, and as a group they are. And then the second question was then to look at valuations and see whether that was at an attractive level to us as well. And from the work that we have done, we are quite comfortable with both the quality of the business as well as the valuations that they are currently trading at. So we are holders of the stock that way. We are comfortable that way. But each of your viewers have to come to their own conclusion as well, because within that group there are a lot of moving parts. There are a lot of interesting businesses, some good, some not so good, and they've come to their own decision. But we have to be very clear. When we buy into Grasim, we do not expect a pure play cement company.
Of course, Adrian, that needless to say that these are your personal thoughts. Our viewers, when they'll be watching the show, they need to exercise discretion and consult their financial advisor when they're investing or buying a stock. Having said that, Adrian, what are your thoughts on pharma? Because the Indian pharma story for the moment is looking slightly shaky. I know you've owned Lupin in the past. Are you hunting for opportunity in the Indian pharma space, or valuations are still not comfortable according to you?
Well, the pharma space is not a cheap place to hunt for value in. So we do need to stick with the operators that have demonstrated a stronger track record. We have Sun Pharma, we have a Lupin exposure. We also have exposure in the likes of Aventis or Sanofi Aventis and Glaxo. All these companies have got strong R&D, strong bench strength of chemists, and very good competent marketing departments that get their drugs accepted in a wide variety of marketplaces. We do not need to hunt for new ideas all the time. I think we do look at the market. It is a dynamic place to be operating in. But for now, we are content with these 4 holdings within the pharmaceutical space.
So, Adrian, according to you, what is the best way to bet on Indian domestic economic recovery. You don't own too much in the PSU space. You have hardly any exposure to any of the public sector enterprise. So are you regretting there, or that was a conscious strategy?
Oh, that's pretty conscious. We pay attention. We have a look at the PSU universe, and we've held PSU stocks before. We have a decent position in Container Corporation, for example, which is one of the strong freight operators in logistic operators in India, and that's a PSU company. But we tend to be quite cautious, because PSU companies do come under greater regulatory scrutiny. There is also they also need to balance profit making with national interests, so that sometimes distorts the decision making. So what we try and do is we try and focus on more commercially focused businesses, and that's why we stayed away from the PSU. As to your first part of your question, which parts of the domestic recovery would we be most exposed to? It's actually in the financial services side. We mentioned HDFC. We also hold a supplementary holding in HDFC Bank. We have Kotak Mahindra. We have ICICI Bank as well, and those are the bigger holdings within the financial services. And we think that given the challenges you have in the credit universe now, those holdings would do well in a recovery.
Do you think it's going to be difficult to make sizable returns in Indian private banks? Because, banks like HDFC Bank or Kotak Mahindra Bank, they're priced to perfection. I mean, these are great companies, and as an Indian, I feel proud that we have such strong financial institutions. They are best in the world. But as an investor, I worry about the valuations they are commanding now. HDFC Bank 5 times book, Kotak Mahindra Bank about 5 times book.
Yeah, that's why they do need to execute, and we pay attention to whether they execute or not. You're right, the financial space is quite a diverse universe. You've got banks and financial institutions that trade at a discount to their book value, and then you've got a small selection of private banks that trade at a premium, as you say. And that's why with the private banks, we demand more from them. We expect them to be better run. We expect them to be clearer about the way they manage their capital allocation. We expect superior numbers of risk management, capital adequacy, and profitability. And they do need to execute to keep up those numbers. But when they do execute, if you look at them over 3, 5, 8 years, you do find that their share price continues to consistently perform. And that's because at the underlying level, they're growing their book sensibly, they are not taking silly risk, and they are managing their portfolio well.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.